Hi, everyone. Thanks for joining and welcome back to Wall Street Silver. Joining us today is the market sniper, Francis Hunt. He is the macro technical analyst and the founder of themarketsniper.com. Welcome back, Francis.
Delighted to be back, guys. Thanks for having me on, Ivan.
Yeah, it's an absolute pleasure having you back, Francis. So, Francis, a lot of people are predicting that with lower CPI numbers that came in, that the Fed is likely to cut rate hikes and gold and silver will likely go higher. How are you seeing it right now, Francis?
Yes, it's an interesting one on the rates. It's been a bit of a one-way bet, the softening on the dollar and the dominance of gold and silver. In fact, gold and silver ran some key technical levels. We'll talk about that, and we'll maybe go for the chart share in a bit. But the other thing is that I see the outriders for the Fed, the likes of Larry Fink of BlackRock, coming out with phrases such as there's still going to be more rate hikes. So they're a bit, I think this is concern about the dollar de-dollarization or the loss of value in dollar becoming a bit too much of a one-way bet and moving too much in your favor. I always say to people, you can be on the right side of the macro trend, but that doesn't mean you get straight line price behavior in your favor day in, day out. Disorderly markets, which become too obvious, it's typically not the game. So I'm expecting that we're at key technical levels and we get a little bit of churn for a while. It could be a pause. I don't see this oil tanker, if I can use that phrase, being turned around in terms of gold, silver, and also even for those that discuss, I think Bitcoin's reversed as well. And we started to get, it was quite ironic, a sniff of an alt market move as well as silver got up to its key technical level. So maybe we should take a look at those charts and just take the temperature, because technical is our game. And let's go straight in with the gold charts. We're really busy on our golds. I always say workshops should be messy if you're a true technician. Guys that have two or three lines are typically probably not doing enough drawing. But if I switch mine on, it'll look like a lot suddenly showing up. So I'll build it in there. That fat red line over there, that is what we refer to as a capping. It's across the top of price behavior. It's descending and it's a grind line. So we've kind of been rejected and refrained from making, sort of new highs. This is what we call the basing descending grind line. And this overall structure is a flag. We had the big pole all the way down there, and that's what we're forecasting. So macro bull, without a doubt, overall. And most importantly, that capping descending grind line got taken out there in that web of work that we've done. So I just wanted to show you where we were on the map before I dropped a time frame. Right. We take it into a little bit of a lower time frame. We've had a lot of fractalized setups. So we had a bit of a squeeze. You typically, when you take out key levels, and this is close to a level, it is descending slightly, but you often get a fractal pattern that forms. And that's what we got, that squeeze there in the pink over there. And that got you away from the key level that you've just broken. There was also a smaller one that was winding you up to break it as well. By the way, we didn't take you on, I don't want to take you to 5 minutes and get too micro about all of this. But then you started to set up what we call a rising wedge as part of this move. So you made our targets. You'll see the target, the short-term target of 2043. Right. And then you spilt out of the rising wedge, which is quite typical, an attempt at a dip down and another grinding attempt. I think we bottom and we churn a bit, and then we start looking for further highs. So this is a level that's seminal for us, the 1949. We've got a lot of people in long. You can see that risk reward there at that level, and this is a huge risk reward, and I'll tell you where the big number is, and that'll get the gold guys salivating quite some. It's a 75.88 risk reward. That means for every unit that you risk $1, you're making 75.88. You put 1,000 on risk on that red zone, you're making $75,880. So where is that green ending at? It's ending at the 2905. So that could point to a technical test of the 3K just through and pull back. Targets are usually, surpassed slightly. But you can see this one was quite tight on the smaller time frame. So let's go back up to that bigger one and just show the bull flag that we were highlighting there. I'm going to clean the face of all the scribblings and get this risk reward in perspective. In fact, even the 3-day might be needed for this guy, possibly the weekly. So this is a macro. you mentioned macro technician when you introduced me, and that's absolutely what we take pride in being. And this is running you from essentially the lows over here. That was around 1150 odd.
Okay.
And that's your bull pole into what we call our all-time high now, which surpassed the 1927 of the 2011. You've matched that again. And this is where you go, 2905, if you're making that bull flag in target. And actually for now, along the lows, you're ahead of the line. So, there's going to be zigging and zagging on that journey. If we're to make it, potentially. You don't go up in straight lines, but that would be a very, very positive thing. And the thing I would like people to think, especially as Wall Street silver, is what is it going to do to the silver?
Exactly.
So I'm going to pivot over to covering the silver for a short bit, but the gold-silver ratio is going to figure in this as well, because we see a reduction in the gold-silver ratio. And we started to see a little bit of that, but then it got truncated. So I'm going to why did it get truncated? Why did the silver get
just before you head over to silver, Francis? So in that gold chart you were showing, you think long term it's about 2,900. That's where the mark you're looking at?
Yes, that's not to say that's the high and then it's a bear market.
Right.
We are macro. I don't think gold and silver has ever seen what's coming, including the 80s era. You've got more behind this bull market than even the events. 2011 was a truncated bull. It didn't even replicate 80s. And when you do, stock markets to gold ounces, you see all of these huge disparities. So, to get the 80s move, into the Volcker years 80s move, we haven't had one since the 80s. That said, we did have bullish periods a little bit where, gold and silver have been let out for a spell, 2011 being one of them. But you haven't seen the fullness, and I think we supersede. So the global indebtedness, everything, I fear it's going to be so big that there could be intervention from government. The risk of confiscation is underpriced. Mines, lots of things could come on the table if it gets too big. Characterization of us and our pet rocks, stopping the green revolution because they can't get silver because these right-wing extremists keep collecting their pet rock and putting them in a hole in the ground. And, I can see this kind of media narrative easily being peddled out when we start to see prices move, as if it's like, it's going to be all about us that has done this. And that's why Elon can't get his silver for his Tesla truck or something like that. So beware, the narratives. We've got to watch for the early signs of that. But let's go to that silver chart, and then I'll show you what's over there about the gold-silver ratio as well. So we've come on that same capping draw. You see the red line again. We've come to, but not properly through. Right. 1, 2, 3. We've been rejected many times here. We've become to, but not through, as part and parcel of that move. It also was this inverted head and shoulder that I drew there. There was a target make here just before that. So you've got to probably gestate and pause for a bit. But I think that's a breath, a short breath before further upside. But you have had, and this is a weekly chart, 1, 2, 3, 4, 5 upside weekly charts. Pretty powerful. We're Tuesday and we've got a mild red so far. So it's a very early candle to make any suppositions on how far. But we could pause, or we could have just a minor intra-week rest and then have another green candle by Friday. We don't know. I would like to see a close above this red line here. That is, again, a capping descending grind line. That would be a continuation from here. The target from that is bringing you to a 45.75. I'm going to ask you to remember that number.
45.75.
Yeah, so we're talking $45 silver. Don't forget, technical targets slightly run through, etc. That could be a 47, it could be a 47.5, but the same applies to gold in that way. So now I'm going to show you something really interesting. Gold-silver ratio. So the gold-silver ratio, we got it here for you. We've got this as being in a macro head and shoulders. So let me just find them quickly, get past all the currencies. By the way, so many new all-time highs in gold and against the other currencies.
Yeah, I've seen that.
That we talk about dollars all the time as, the canary in the gold mine, but you've got all-time highs across so many currencies right now. So this is a complex macro chart. It's kind of a foxy one for people to get, but we called the turn in the debt markets on the events of March 2020. I won't say the name for your YouTube. And we called the turn in gold silver ratio to coincide with that. So these things are diametrically opposed. One is debt, which is liability money. FX currency is borrowed into existence, comes with a liability. Right. The other is gold, and it has no liability. It has no T-bill accounting. You hold it, you own it. It's not somebody else's debt. It's not somebody else's asset, etc., etc. So we've got this fiat system. So this was the turning point for the fiat system and the debt system. People need to understand currency is borrowed into existence by debt and created. So this has major effects for fiat currency and debt markets and gold as physical elements. That peak over there was around 128. You came down really hard. We call this a proper slap in the face. When you get price action like that, and it bottomed in and around the 65. The logical round number is 65, very similar to here. So we are calling this as a left shoulder, a very complex. Think of the guy going to gym and having a hell of a pair of trapezius there, down head, and then you've got a broadening structure on the right shoulder. So that's what we've called. Now, broadening structures are inability to continue upwards. And we've said that this would come down. You had a rally up here and you've come down really, really hard. So I'm going to drill back down into, I needed to just give you the big picture. I'm going to go in and give you the where we are now element. But just so that everybody understood when they were looking at this chart, what are we seeing? So the interesting part of the financial mathematics is if you say gold to 2.9, let's say it gets a technical run of 3,000, we also see as part of that process, a revisit to the neckline, that's the 65 of the gold-silver ratio. Now, typically when you're having a gold bull market, the gold-silver ratio is also reflecting that, only it's to the downside because we've got gold first and it doesn't go up as fast. So if we were to get a minor rally here to this cluster of levels, a hard down here again, and another one, and then we go to the downside, I would guess we would be at the 65 and having a bit of a rally when gold rests at the 2,900, 3,000 mark. So where will silver be?
45.75, is that the price?
Well, we got that from the silver chart. Mathematically, let's look at the gold target and the gold-silver ratio. So if you have a 3,000 gold, and I'm going to pull up a calculator to help those that mathematics was not a favorite subject and was some time ago. But if we just go into the calculator and bring him up and do some rudimentary maths, what would happen if at the first point of rest, back at the neckline, you have $3,000 gold. Right. So technical run through that 2.9, and we have a 65 gold-silver ratio. That means silver is going to be 3,000 divided by 65. 46,000. Now that's just dovetailed with the technical target that I gave you to remember, which was 45.75.
Right.
So you could see technical analysis, two different angles of technical analysis. So we verified a silver target at, again, for those that are the mega bulls, don't shout, that's nothing. We got to go to 250, 500. Yes, in time, time. Don't forget this head and shoulders is now going to collapse down to 32.8 to make its target and overshoot that. And we've actually called possibly single-digit gold-silver ratio. That means sub-10. But that all comes in time. We're talking about what's the next leg. We're going on a journey here, and we're having stopover points where we're not making further progress. And I'm telling you about this next leg of the journey to your next stopover point where you might get pullback, but a bit more fluffings for the fiat currencies, etc. They'll pull whatever they can and do whatever they can. So it's quite interesting, I thought, that looking at gold's targets and the potential gold-silver ratios targets, this is where we'd expect to bounce, because you're about to trigger now the macro head and shoulders. So it's a key level, the 65 point. You'll come down, you'll bounce. That's not tomorrow. It's not next week. It's not next month. This is going to unfurl for a while. We're talking about a 50% gold a move in gold potential, and we're talking about on silver, you're talking about a doubling, just about near doubling, 80-90% dependent. So these things will unfurl, but that doesn't mean they take forever. It could be indeed this year, the latter half of the year. It could happen very disorderly, very quickly. I can't answer that. That's beyond the scope of macro technical analysis. But I can tell you that the gold move, the original gold move, took 13 months from when it stopped at the lows. Now, if it were to equal that, it would be 13 months. My suspicion is we're going to be a lot quicker. The move up leg is going to be a lot quicker, and a lot more of the narratives has moved in our favor. So I think $45, $47 range is the next sleeping point. Don't forget, technical highs for silver are the 49 sub 50 level, the 48, 59. You look at the 80s, I'm getting a 48 number. You're looking at the 2011s. I think we got a 49 number. That is a $50 is like a big move we've never had. $50 silver we haven't had. In time, we smash it, we go well beyond, likely to be a technical resistance for a spell though, and potentially see pullbacks. So that's a bit of charting for you. I'll give you a chance to unpack some of that.
No, that was phenomenal. Like that, everything you said on is really spot on with us. We would love to see $50 silver. That would make everyone in Wall Street Silver go crazy. Where do you talked about the potential with silver and gold, but what about, let's say, the gold and silver miners? Do you see any potential there, Francis?
Yes. And the question is, why do miners lag? There's a couple of reasons why miners lag. One swallow does not make a summer, and silver price is particularly very high. You know, we've had 30 during the Wall Street silver bets spell, and then next thing you knew, we were trading 16. So people get battered on silver. There's only 18% of production is pure silver miner production, bear in mind. Silver is actually a byproduct of most things. It's either recycling or byproducts of nickel, copper, gold miners. So there's actually predicted less than 20% is pure play. In other words, it's so non-economic. It's kind of how Rick Rule was talking about uranium a year or two ago. It's just a terrible business. And what you've now had is also inflationary costs that have come in. It takes an immense amount of energy to go break rocks deep down, bring them up, refine, and do that. And energy costs have absolutely escalated as well. So the cost, then you add the ESG stuff, then all the licensing, the paperwork. What they've actually increased are the barriers to entry, which are on a negative now, but become a super bull feature when we have the shortage and the excess demand. Because new entrants are decades away from getting anywhere. If they're not already exploring or they don't already have proven ounces in the ground, they're nowhere. They're in nowhere land. So miners lag. They will lag. You need the gold bull to really be on. People sell forward as well. And there's royalty companies that have also got lock-in prices at a certain level. Generally, people don't over royalty. It's normally 10, 15%. Some exceptional cases, you might find they've got a total of 20% of their production royalties. But that means that a lot of that benefit doesn't fall on their bottom line straight away. Their costs have gone up. That's why. So it's in the second and third stages where you get the supermoon. Because of all those costs and the marginal utility, if they go from being slightly negative to and the price changes by a couple of dollars, that makes them highly positive. That's why they get the multiple in the move. But they will be super spikes. It'll be crypto-esque type markets. And I do feel that, you know, there are scopes for 100x's, not 10 baggers. There are on the micro caps. But this comes with a warning. There will be some people that have, you know, frauds possibly, that have sold, you know, we've got 100 million ounces in the ground. We'll get 10 million ounces a year for 10 years. We should be worth 6 billion. And you turn out it's not quite as good as it needs. Getting mines to production, lots of blocks. So you have a lot of structural matters. I would say African, you know, a lot of the miners with Guinea and places like that, it's easier to get a mine into production there now than it is in the West. So Mexico, good areas like those that are accustomed to it, probably better than almost US mining because of the ESG. But you have less risk in other areas, such in, you know, civil unrest, coups, and various other things in terms of America. So miners will lag.
Mm-hmm.
So you will have time to load up. The best play is gold first, God market. Then you roll some of your holdings into silver as the gold silver ratio breaks down to 65. It won't be too long then, I think, that surrenders. You might want to just keep as little as 20% in gold or a third in gold and pivot a lot of it to silver. And then there'll come a point as you start getting to 32.8 and even maybe the single digits you hold on, you might want to rotate some of that silver back into gold or other assets, property, and things that will go back to yielding. Here's a very interesting thought. I did a very interesting interview. The biggest criticism of gold and silver is it doesn't yield anything.
Yeah, that's right.
All of this. This is the Warren Buffett narrative and all of these people. What we've actually had is a 40-year hyper bull cycle chasing asset values of things that yield. Property, shares, etc., to the point of hyper valuations that are no longer sustainable. The debt markets, they essentially yield, but they're yielding a negative yield to a true inflation rate. So it's better to have something that holds capital value and holds at least to the inflation rate and potentially more. So we've hypervalued. The search for yield has been a 40-year theme that you actually have such distortions that owning something that hasn't been hypervalued because it yields and actually is hyper undervalued and will capital gain in the failing currency. In fact, it's only standing still in truth, but it will capital gain in the failing currency because of being punished for non-yielding. So you've had this perversion where one market is super overshot for yield. Now those yields are negative. The true inflation rates for us are double digits, almost certainly, particularly for, you know, reasonable income level people. And I would also argue biting pretty hard on blue collar as well. So the truth be told, the capital gains is going to compensate on the hyper undervalued assets that don't yield, because they are there for inflation purposes. They are there and they will go up by the true inflation. And what you'll actually have is an over-investment pool of money in the hyper yielding assets that are now actually negative yielding to real inflation, flowing out into gold, that you actually get a corrective capital gain on top of your inflation gain. And such is the 40-year excess of the pursuit of yield. You are going to have that 40 years of excess squeezed into a much smaller time period of rebalancing. Everyone's going to run to the other side of the ship at the same time. And so what you're going to have a real tip and a surplus in the capital preservation, non-yield capital preservation being the theme, and capital preservation is going to give you capital gains coming out of your nose, that it is your replacement for yield on the items that are no longer yielding because they've been so hypervalued in real terms. So I don't know if people followed that. It might be a bit of a word sandwich, but that is what's going to happen.
So, Francis, I was just looking in a couple articles over the weekend, and Janet Yellen was saying, she was talking about economic sanctions that were being imposed on Russia by the US last year and a few years ago. She's now saying that it has put the US dollar at basically at a risk, the US dollar's dominance at risk. So my question to you is, did the sanctions hurt Russia, or are they backfiring now and hurting the US dollar?
Oh, it was the stupidest thing that could have done. That was an own goal. That was shooting yourself in your own foot, for sure. It immediately got everybody thinking. Some people will put down to stupidity that I put down to design. We can argue about that. If you want to accelerate the de-dollarization, that's the perfect theme to do it. And that absolutely worked against America more than it's worked against Russia. And it's given Russia the perfect accelerant to developing their own infrastructural highways for payment flows, bilaterals. And it's encouraged and emboldened nations so much so that you've got little old Kenya saying, having a pop at the dollar. You've got bilaterals between China and Brazil, and inside the BRICS, obviously, doing trade in yuan. Maybe the real will be involved. I'm not sure. And I want to also do a look forward. I'm shocked by almost that moment of truth and admittance and self-awareness and self-reflection there by Yellen, although she's probably not the main driver behind sanctions. I think there's a scope for them to repeat the error and further accelerate the capitulation with China. So China's going to be doing some drills off Taiwan, as mentioned in the pre-chat. Now, one of those drills could go live, but, you'll bet on those 10 times and you'll be wrong when it's the 11th one that does. But at some point, with a possible Trump Republican candidacy being possible again, I saw him taking shots at DeSantis. I think the Chinese, if they were to do anything aggressive with Taiwan, they'd prefer to do it under a Biden regime than a Trump regime. But anyway, if they waited for a Trump regime, there'd certainly be at least financial repercussions and sanctions. So a geopolitical act like that could bring in those repercussions, or they could just lean on you supplying Russia and repeat the error of taking Russia's money and do the same to China. And that would then reduce the dollar to very much a Western currency because a lot of nations would fall, and Commonwealth, of course, a lot of nations. So there's don't underestimate the possibility that behind schedule. In my point of view, it's by design. But other people will think incompetence. We don't have to argue about that. But watch that error be repeated on China, and watch the consequences be far higher as the manufacturer. I mean, if you look at how many things are made in Russia versus made in China in the States, there is an order of multitude that is so much bigger. And that, again, is going to accelerate payment pathways, bilaterals, with all forms of nations and de-dollarization. And that could truly put a blowtorch under gold, because it's not, and I want to highlight this, I'm not a yuan fanboy. I'm not any fiat currency fanboy. There is nothing that replaces the dollar. There's nothing that's set to replace the dollar. And many people will also highlight, the liquidity in derivative markets, most of the weapons of mass destruction type markets as well, that we could probably do without, remains dollar-based for people that want to do. But they were there for original purpose. You used to hedge, mines could hedge. We spoke already about forward selling silver supply and not getting the benefit of recent price action as one of the reasons why mines might lag. But that's also useful because they know how much their costs are. They ensure a minimum return if the silver price collapses, and now they're running at a loss. You've got people that have borrowed lots of money, banks that are not keen to lend in that space anymore, following, the BlackRock type ESG agenda. So, there's a lot of things, and I wouldn't put it past the error being doubled down, even though you've got someone as senior as the Treasury Secretary actually admitting that they've accelerated dollar denomination. I think it's part of bringing the dollar's dominance down, and that error could, in fact, be repeated, and it would be repeated on a far larger scale of effect, possibly. And it could be geopolitical, something triggered by China taking action, or they could just tie them in and saying, we think you've been helping Russia and pass arms or anything. So it's a mistake that it's a landmine. They're ready to, the one good remaining leg, it could be searching for the second landmine, if you know what I mean. And then they truly can say they haven't given up the fight, from the Monty Python sketch, as a stump bouncing around. That is a real threat.
Absolutely. Well, it's Francis, it's been an absolute pleasure having you on Wall Street Silver. It was a fascinating interview. And we'd hope to have you back soon. That was incredible.
Absolute pleasure. People can engage with our YouTube under the Market Sniper. And if they want to book a call, be part of our community on themarketsniper.com.
We will put your Market Sniper, the YouTube channel, in the description, and your social media, so everyone can connect with you there.
Excellent. Thanks for having me on, guys. Have a great day.
Yes, absolute pleasure. Talk to you soon.